moving to Outlook on page 21, clearly our business is right at the forefront. Our clients have a very high focus on safety as we do. We don't want any of our people to go home harmed. We have a zero harm policy, and it is a discriminator in working for the clients. Our mining activity remains healthy. There's quite a few new underground developments and brownfield developments on the horizon. I guess there is distraction from outside issues that sort of delay when they come to pass, but we believe there's a high probability of these projects continuing. First contracts are being awarded across the CSG LNG space, very encouraging, and we believe we're well positioned to pick up this work. We've got a very high level of tendering activity. We are being very selective on what we bid. We're not bidding everything. We're bidding the stuff that we believe that suits us, and we're supporting our key clients. We're certainly focused on building long-term relationships with our key clients. They've supported us. We want to support them. Our balance sheet, I think, is very well positioned in these uncertain times to take advantage of the opportunities as they present. We are reviewing our dividend policy. As I mentioned, we're paying a 1 cent dividend at the moment, but we are going to review our dividend policy to take account of the organic investment opportunities, and if it adds value for our shareholders, then we may review the payout ratio. We believe, looking forward, that our profitability will continue to improve. We're expecting revenue growth equal to or greater than we've achieved this year. I do think there'll be probably more of a second half impact in respect to the orders being expected to be placed, particularly in the CSG and probably some of the new greenfield coal expansion. And we look forward to the coming year with anticipation and confidence. So that completes my presentation. So at this point, we'd be most happy to take questions.
Ladies and gentlemen, if you wish to ask a question, please press star one on your telephone and wait for your name to be announced. Your first question comes from John O'Shea from Bell Potter Securities. Please ask your question.
Morning, Terry and Ann. I just had a question regarding the mining business, in particular the margins. If you could perhaps talk me through, perhaps in a bit more detail, what's actually happened there. They're just a tad lower than I thought they'd be, and perhaps give us some guidance as to what you think that margin could look like for FY12. And secondly, just on the order book, if you just give us some sense of the length of time in terms of what sort of time frame that order book is sort of spread over.
Okay, well, Ann and I will both answer this. I'll come firstly to the mining margins.
Sure.
We've been consistent, through the year that we have had some margin issues in our mining, and look, a new issue was a number of our regional workshops where we had some under-recoveries, where the work volumes didn't come through to support some of the overheads that we had, and there were some delivery issues which did have an impact on margin, and we've done work to correct that. We're certainly working very hard to improve the margins, and I'm forecasting we will lift the margins in the coming 12 months. It's less than we would like. There are pressures on labour and other events, and it still is a competitive workplace out there. And one of the things we've been very keen to do is, I guess, hold our market share, which we've successfully done, and that's cost a little bit. So we do expect the margins to improve, John. In respect to the order book
sorry, Terry, before you go on to that, when you say improve, do you think in what sort of in a broad number in the 12 somewhere, or can you give us some sort of sense of how much these issues that you have experienced this year are likely to be repeated again next year? That's kind of where I'm coming from.
John, what Terry's saying, we expect the margins to improve. So certainly, above where we're at this point in time.
Okay.
Even getting back to last year's margin.
No.
Last year's were quite a high margin on it, so it's going to be an improvement, but not up to the level of last year.
No worries. Thanks, Terry.
Okay, I think the other question was in respect to the order book.
Yeah, just sort of time frames there as to what sort of time frame it's spread over.
Yeah, well, we've not normally given a phasing of the order book, John. I guess we've not normally broken it up by what's this year and next year.
Predominantly the order book, particularly E&I, we have said, before, most of that, what we have in the order book is shorter focused.
Sure, yeah.
So, you're really looking predominantly, for the current year, with a bit sitting out into FY13.
Sure, yeah. That's what I would have thought. That's what I was expecting, that most of E&I would be 12 months type stuff. And
I would say that in the tenders that we're submitting, John, there are clearly some longer-term contracts.
Yes.
It's spread over a couple of years, so we've got a mix. So the mix is actually changing a bit to a few more larger projects with a few more spread over a period.
Yes. Okay.
If we're successful, and I guess the thing is we're still at the whim of our clients of when they'll actually place them.
That's it, guys. Well done on the cash flow on the balance sheet. Looks good. Thank you.
Okay, thanks, John.
The next question comes from Damon Callahan of JP Morgan. Please ask your question.
Good morning, all. Yeah, my question's already been answered. I was just going to ask on the mining business margins as well. Thank you.
Thank you. Thanks, Damien.
Your next question comes from Andrew Tan of Bell Potter. Please ask your question.
G'day, I just wanted a bit more colour on the FY11 CapEx spend. 12.3 million is split between maintenance CapEx and growth CapEx.
Predominantly, the spend has been in maintenance CapEx. As we've said, there's 16 million worth of CapEx that has been approved, which the spend will actually happen in this year. As you're aware, with the type of CapEx that we have, there's long lead times. So We've ordered CapEx, we've ordered a couple of drill rigs, and the two continuous miners that Terry mentioned, the ones that are undergoing rebuild. Most of that CapEx spend will actually happen in this year. So there are two additional continuous miners. They'll have a total of 7. Most of FY11 is maintenance, but we've already approved growth CapEx that we will, in fact, incur the cost in FY12.
Okay, and is the $12 million of maintenance CapEx the kind of the level of maintenance CapEx going forward?
Look, I would think it's around about that level of maintenance CapEx. It might be a little bit less, somewhere, depending on the individual years, what needs to be done on the pieces of equipment, somewhere between 8 and 12.
Okay, and in terms of the E&I division, plant utilisation, can we get a feel for the level of utilisation across the fleet?
It's running at about 41% at the moment, which is, it's sort of hovered around that. It's actually lifted a little bit just of late, but until some of these, as I mentioned to you, on the infrastructure side, there haven't been too many large pipelines which sort of suck up a lot of this fleet. There was one we completed a year, the APA Young Tawagga. We've had a few shorter cycle projects up at Silver Springs, for example, and around the place. But until some of these larger CSG contracts start to fall, we won't sort of start to see some of these assets being used. Now,
sure.
That also has a margin impact as well, because if that equipment is working, it's just some of this gear is actually working, we actually make a pretty good return. So we get a double whammy. But
how's that? Sorry.
Go ahead. Yeah.
Yeah. How's that 41% compared to, I guess, the peak kind of levels of optimal performance? Like, does it always only operate at 60%?
No, we would be expecting it to operate higher. But, Andrew, it's difficult. We've got various different pieces of equipment in the fleet.
Yeah.
So just now we have we've got TBMs that are operating. We have drill rigs that are operating. The pipeline laying equipment is not operating. So, not all of that equipment we do anticipate to operate 100%.
Yep.
And that's the way we cost the plant out. But there's certainly, parts of our fleet that are capable of operating at a higher utilisation than they're currently operating.
Okay, and I had a final question about legacy contracts. In the annual report, there was a comment about legacy contracts coming to an end early this financial year. What kind of impact on margins has that been in terms of, what proportion of revenues are under the legacy contracts in EBITDA?
We're not really. Look, we haven't broken that out. Clearly, the number of legacy contracts that are impacting are reducing.
Yep.
A couple of them have actually finished. There is, we've still got a number which are coming to a close. They're having a reducing impact. I guess I'll go as far as to say that, but we have closed a few out.
Would you see a corresponding increase in margins from the closure of these legacy contracts?
We're forecasting an improvement in margin, yeah.
Okay, no worries. Thank you.
Thanks, Andrew.
Your next question comes from John O'Shea of Bell Potter Securities again. Please ask your question.
Sorry, Terry and Anne, just one more question. I just wanted to clarify sort of something to follow on from what Andrew said, just so that I'm absolutely clear. Your guidance or your general comments regarding CapEx for next year, obviously if let's say we assume 10 million of maintenance CapEx and then we add another 16 of growth CapEx, is that what you were saying, Anne?
Yeah, look, yes, it could be around about that level.
Okay, that's fine.
It could be, and there may be other amounts of capex, but again, with us, it's the timing of that cash flow. We might approve more than that in the coming year, but the cash flow would fall into FY13.
Yeah, that's all right. No, I just wanted to make sure they understood properly.
That would be reasonable.
But I want to just, for the avoidance of doubt, John and others, what we've done with our balance sheet is that we expect that there could well be some opportunities come up. And we've certainly got the capacity to make those investments, assuming the returns are there. And so, that would be our expectation. But who's to say what might just pop up because we're in a couple of growth markets. So, it may change.
Sure. Thanks, guys.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. There are no further questions at this time. Back to you.
Okay, well, look, I'd just like to thank you all for dialing in. And look, if anyone's got any things they want to raise, we're seeing a lot of you over the course of the next few days. But if anybody's got any points, feel free to call Anne or myself, and we'll try and answer your queries. And thank you for your input this morning on a pretty busy day, as I understand.
Thank you.
Thank you.
That does conclude our conference for today. Thank you for participating. You may all disconnect.